Okay. Good morning, students. How are you doing? Well, I'm back with our class on Paper-2, Corporate and Other Laws. We are running a little behind schedule, but it doesn't really matter because the objective is that as students, you are able to understand what we are doing here for you, right? So I hope everybody is all charged up for today's class. Early morning classes can be the best one because this is the time where your brain is absolutely free, no distractions, nothing, and you can totally put all your 100% concentration on what is being taught here. So, in the previous classes, we are already done with 3 chapters, and in the last class, we have already spoken about prospectus and allotment of securities, where we spoke about what a prospectus is, what are its contents, how securities are allotted in case of public company, what are the legal requirements, how securities are allotted in case of private placement, that is through private placement, what are the legal requirements, offer for sale, IFP, IPO, FPO. So we are done with these concepts. I hope all of you are through with that. Thank you, Surya, that you're waiting for my class since 2 days. In that case, I expect from you to get an exemption in law if you are so dedicated. Okay, so today we are gonna begin with our next chapter, which talks about share capital and debentures, right? Now, this chapter as such, which is chapter 4, is comprising of not much of sections. So it is basically section 43 to 72. However, some sections have been removed or reduced from your syllabus, which includes section 44, 45, 60, 65, 72. Even though their removal doesn't make much of a difference, as the key points are any which ways there, but since these sections have been removed, we will not be covering them. However, if I feel the need somewhere that from your knowledge point of view, you should be aware of this particular part, I will definitely let you know. So see, my agenda is that you just don't read company law for the sake of clearing the examination. But my agenda is that when you step out of the ICAI and you become a chartered accountant, at least you have your fundamentals in place. Because trust me, we have students who come for internships and it gets very difficult to tackle them when they know nothing, when they don't understand the basics even. So probably you would realize the worth of reading the bare acts or ma'am just making you do the absolutely legal point of views is when you start and become a chartered accountant. Anyways, the first step is that we have to clear our examinations. So yes, we will understand the concepts, build notes out of it, and prepare for your examination point of view. I would request all of you to start making notes of the chapters that we have covered. Start making your flow charts, your diagrams, your bubble diagrams, anything that you like, stories, anything that can help you remember things. What you can do for punishments, you can list down all the offenses in a table and then mention the punishment parallelly for officer in default in company. So these things are something that you can start building upon. So that when the time comes for examination, you are ready to revise from your notes. You don't have to read out the study material. So study material is for basics when you start, when you have to do it in detail. Once you are done with the basics, you have prepared your notes, your notes are good to go. Okay, so starting with our today's session where we will be talking about share capital, share, stock, and debentures. Debentures is not something that I'm going to touch down today. Today, we will only talk about what are the kinds of share capital, what is a share, how is it different from a stock, and what are the voting rights, what are the different kind of share capitals. All these kind of information we'll be covering under this chapter. So we already understand this, that wherever a company is limited by shares, it has a share capital. Now, what is this share capital? how do you understand share capital? So if you ever have a chance to look at the MOA or AOA of the company, you will get to see that it says that the paid up share capital of the company is, let's say it says paid up capital is rupees 10,000 and authorized capital is 1 lakh rupees. So what is it? The share capital, the amount that can be invested in the company for it to carry on its business. Any sort of company be there, it needs money for business. So recently I read the news where Mama Earth, which is comparatively a New Year brand, is hiring 200 employees because they have reached a certain benchmark of turnover. So when they are hiring employees, there is expenditure to it. So obviously share capital is not spent for regular expenditures, but yes, when they are hiring employees, they will further expand also. So for the amount that is needed that can be invested in the company is called the share capital of the company. Now, share capital is a huge amount. One person, if let's say if the share capital of the company is 500 CR or 100 CR, it might not be really possible for one person to invest the entire money. And any which ways, a company needs at least 2 members. This is what we understand from the structure, right? So private company needs at least 2 members and the public company needs at least 7 members. This is something we already know. So what happens? The share capital as a whole, it is divided into small chunks, the smallest unit. This smallest unit are called shares. So let's say, can I buy 1 share of Reliance Industries? Yes, I can buy one. Maybe that 1 share costs rupee 10,000 or 7,000. I don't know what's the current price. I really do not follow the share market. But yes, so shares are nothing but the smallest unit in which the share capital company are broken down. So when you break it down to the smallest unit, which is share, the share capital as such can be of various types, right? So share is the smallest unit, but depending on the type of capital, the rights attached to these classes of capital are also different. So we know there is equity capital, there is debt capital, and there is preference share capital. So debt capital is the amount that is used for rolling out debentures, bonds, etc., right? And equity and preference share capital is the capital through which equity shares and the preference shares are released in the market. So we understand these concepts. So the people who hold the shares of the company, they are called the shareholders, and people who have the ownership of debentures, they are called the debenture holders. Now the term shareholder as such has not been defined anywhere in the Companies Act, but we definitely understand that when the share gets allotted to a person, he becomes the holder or the owner of the shares. He is known as the shareholder, right? So there is this example that I have given here for you. Just have a look. So Sun Bankers Limited has authorized share capital of 50 lakh rupees. The face value of each unit of capital or share is 10. That means total capital is 50 lakh rupees. The smallest unit, the price of 1 share is rupees 10, right? So how many shares does the company has? The company has 5 lakh shares. So the entire share capital has broken down into smaller units, which come out to be 5 lakh unit. And these shares can be allotted to different people who become shareholders of the company, right? Now, this shares which are allotted to the people, if they are fully paid up, they can be merged together into a fund, and then they are called the stock. So stock is nothing but a bundle of fully paid up shares. So shares are the smaller unit. The smaller fully paid up unit of shares, when they are combined together, when they are put in together as a bundle, the collection, they are known as the stock. So shares and stock are two different things. We often tend to use these words interchangeably, but they are not the same thing, right? Are we clear on this? So we know what a share is and what a stock is. So in your examination also, do not interchange these two terms when you're writing your answer, because that will give you an understanding that you are still not clear on your basics. So share and stock are different. Share is the single smallest unit. The paid up share capital, the bundle of paid up share capital is called the stock, right? Now, the shares, so here I have done a small differentiation for share and stock. Well, it is not really, doesn't come in your exam as such, but it is good for you to know, to be able to differentiate the two. So the share capital are the smallest unit and the stock is a bundle of fully paid up shares. Secondly, shares are issued in original, but stocks cannot be issued in original. It is obtained by converting the fully paid up shares, accumulating the fully paid up shares and converting it into stock. So shares are as such issued in original, but stock can never be issued in original, right? And shares can be fully paid or they can be partly paid also, but the stocks, they are always fully paid. The next important point is that there are a fixed denomination and a fixed number associated to share. For stock, there are no such guideline, right? And the shares as such are transferred in its entirety, right? Or in its multiple. So any which ways it is smallest unit. So it will always be transferred in its multiple, because, but when you talk about stock, so stock being the bundle or the collection, they can be broken down into fractional amount, right? And stocks can be made only if it is authorized by AOA, and it can be done by passing the OR, which is the ordinary resolution. And when we talk about shares, we know that registration of share capital is mandatory. So are we good with this definition of share and stock? Is it good with everyone? Okay, now proceeding further, we are going to talk about the different kinds of capital. Now, these different kinds of capital I had already discussed when we were talking about chapter 1, where we discussed the definitions, right? The key definitions. However, since we might have few students who would not have attended my first class, this is why in a brief, I will tell you about different kinds of capital. So we are not talking about different kinds of share capital. We are talking about different kinds of capital, right? So there is authorized capital, which is defined under section 2, subclause 8, right? So what is the authorized capital? Authorized capital is the maximum amount of share capital of the company, and it is the amount that is mentioned in the memorandum of the company. So that is the maximum amount. Issued capital is a part of authorized capital which is issued to the public for subscription. Now, what is issued to the public? Out of it, maybe the entire issued capital is subscribed, or it could be that some percentage of it gets subscribed. So let's say 95% got subscribed of the issued capital. So the capital for which subscription have been received, that is called subscribed capital. Now on the subscribed capital, some part of the value of the share would be paid. So that amount that is already paid is called paid up capital, and the amount which remains unpaid and the call is sent on it to receive the payment, that is called the called up capital, right? Right? So these are the different kinds of capital, or the different terminologies pertaining to capital that you get to hear, right? So authorized, issued, subscribed, called up, paid, right? 2, 50, 86, 15, 64. So you will have to build up your own mnemonics for remembering things. Okay. Okay, so I've got a query. So Ritu is asking me, stock is divisible in any amount and even transferred in fractional amount means. So Ritu, you need to understand stock is nothing but a bundle of shares. So we know that share is the smallest unit, but stock is the bundle. So let's say this is a bundle of pens, right? Can you divide this bundle? Yes, I can give one to Ritu. I can give one to Satish. I can give one to Surya. I can give one to Apurva. So this is what is meant here. Because it is a bundle, it is a collection, it can be broken down and then transferred. Is that clear? Okay. Now, after understanding the capital part, now let us understand the kinds of share capital, how the distribution of share capital happens. So yes, generally we see, so debt capital we will be talking about when we are speaking about debentures, but when we talking about share capital, right? So it will be equity share capital and the preference share capital. What do you understand when you hear the word equity? Equity share capital. What do you understand from the word equity? Please tell me, please share your answers. What is meant by equity? Right? So equity is nothing but your rights in the company, your rights in the share capital. Now, how do you own the equity of the company? You purchase the equity of the company by paying money, right? This is what you do. So that is the equity share capital. But along with the equity share capital, there is a preference share capital as well. Now, when you hear the word preference, you understand that there will be a preferable treatment, some benefits given to you. Now, there are a lot of people who are really not interested in participating in day-to-day functioning of the company. Rather, they are more concerned with the return on their investment. So there is a preference share capital through which the company raises the money from the market, but it continues to have control. So how does this happen? What is this entire agenda of preference share capital and equity share capital? We will be talking in detail. So coming to the equity share capital. So this equity share capital, it comes with a voting right, or it can also come with differential voting right as to dividend voting or otherwise. So generally the principle goes as one share, one vote, right? This is how the principle is. But it is permitted to issue shares with differential voting rights. So you need to understand under equity share capital, and every person who owns an equity share has a right to vote on every resolution of the company. So on every kind of resolution, on every decision making process, a person who has an equity share of the company has a right to vote, right? Now, when a person is issued equity share with differential rights, that means there is some tweaking or some difference in the rights that are allotted to them. So it could be a higher dividend, lesser voting, or or some other thing. So there will be some variation to the standard protocol that is followed, right? And similarly, when we look at preference share capital, why is it called preference share capital? Because it carries the preference right. Preference right pertaining to the payment of capital, payment of dividend, and repayment of capital at the time of winding up. Okay. So you need to understand when we talk about these preferences, this comes with the share itself, right? So when I say I have a preference right to payment of dividend, that means if the company has surplus profit and it will release the dividend in the market, the dividend will be first paid to the owners of the preference share, and whatever is left behind, it will be given to the people who have the equity share. So preference in respect of payment of dividend, also when the company goes into winding up, it is the preference shareholders who are first paid with their capital, and then whatever is left behind is divided amongst the people with equity share capital, right? So this is how the preference share capital and the equity share capital function. Now, we also know that when we talk about section 43, which talks about kinds of share capital, there is an exemption to private company. So if the private company wants, in its memorandum or articles, can tweak the requirement of capital. But this exemption can be availed by a private company only when it has not defaulted in filing of its financial statements under 137 or annual return. So wherever we will get to see throughout the company law, wherever you get to see that there are exemption to a private company or a public IFSC or private IFSC or a government company, you will always see that it comes with the clause where it says that the exemption shall be applicable to a private company which has not committed a default in filing of financial statements or annual returns. So this is something mandatory that we get to see throughout, right? So as the basics, are you able to understand how does the equity share capital and the preference share capital function, right? Now, one by one, we will take up these different kinds of capital. So this was the basic that I told you. Now we can do it with it in details. Yes, Mrunal, you are absolutely right on what you have mentioned here. Yes, you are right that preference shareholders will be having fixed date and rate of dividend, unlike equity shareholder, which does not have any rate of dividend or may not even obtain dividend. Equity shares have equal voting right, correct? But preference shares do not have equal voting right. In equity shares also, if the shares are issued with the differential voting right, they might not be equal. So equity shares can either be equal or it can come with a differential voting right. That depends what kind of equity share capital is being raised. Okay. Now proceeding on to the details of preference share capital. So the word preference only indicates that this person has this share capital has a priority in terms of payment of dividend, in payment of capital in case of winding up of the company. So two preferences are given. One is D, one is the R. So preference share capital is a doctor. Why is it a doctor? Because it is a preferred right to payment of dividend. D stands for dividend and R stands for repayment in case of winding up or repayment of capital of the company, right? So you can remember this preference share capital with this mnemonics, doctor. Okay, so let us quickly read the go through section 43 what it says. So it's section 43 says preference share capital with reference to any company limited by share means that part of the issued share capital. Please mark the word issued share capital of the company which carries or would carry a preferential right. Now, this preferential right is with respect to payment of dividend, either as fixed amount or an amount calculated at a fixed rate, right? So the dividend which is to be paid to the preference shareholders, they are either the fixed amount or the rate at which the payment will be made is fixed, right? It is predetermined, right? Which may either be free or subject to income tax. Now, this point that this dividend that is paid to the preference shareholder could either be tax-free or it could be subject to income tax. Both the situations are possible. Point R stands for repayment. So, when the company goes for winding up or there is a repayment of capital of the amount of share capital paid up or deemed to have been paid up, there is a preferential right to the payment of any fixed premium or premium on a fixed scale. So what we are saying, let's say the preference shareholder they paid an amount of rupees 100 towards the share capital, right? So when it comes to repayment at the time of winding up, they have a right to payment on a fixed premium. So it could be that the premium would be 5%. So if the premium is 5%, instead of rupees 100, when the company is going for winding up or when there is a repayment of capital, instead of 100 rupees, they will receive rupees 105. Now this premium that is to be paid to the preference shareholder at the time of repayment of capital is specified in the memorandum or the articles of the company. And this premium could be anything. It could be 5%, it could be 10%, but whatever percentage is defined, that will have to be paid. Apurva is asking me, ma'am, do preference shareholders have voting rights? Yes, preference shares have voting rights, but only on the matters which directly affect them. So whenever there are matters which directly affect their rights, they have a right to vote on it. But in cases where the dividend of the preference shareholders have not been continuously paid for a period of 2 years, in that case, preference shareholders have a right to vote on every matter of the company. So we cannot say that they do not have the voting right. They have a voting right, but only on the matters that affect them. Whereas when you look at equity shareholders, they have a right to vote on every business of the company. Now, there is a explanation to section 43, which talks about deemed preference share capital. So whenever the word deemed comes, you need to understand, well, if I say this is a highlighter, but this will be considered as a pen. So there will be certain situation where this highlighter would be considered as a pen. So this is what is meant by deemed. So when we looked at deemed preference share capital, there would be a share capital which will considered to be a preference share capital, but as such it is not. So the explanation says, let's look at it. I'll explain it to you. This is a very important point because the way it is worded, it often creates confusion in the mind of students. So pay attention here. So explanation 3 says, the capital will be deemed to be preference share capital whether or not it has either or both of the following rights. So it is saying whether the share capital comes with any of these rights or not, it will be deemed to be a preference share capital. So when I will do the details of the preference share capital, where we will be talking about types of preference share capital, there we talk about participatory and non-participatory preference share capital. So what happens here? So we know that when there is a preference share capital, the right to first payment of dividend goes to the preference shareholder. Whatever is left behind is divided amongst the equity shareholder, right? But there is a possibility that after payment of dividends to the equity shareholder, there is a surplus that is left behind, right? There is a surplus money that is left behind. So when the preference share capital holder has a right to participate in that surplus profit, it will be deemed to be a preference share capital. Similarly, when the preference share capital has a right to participate in the surplus asset which is left behind after repayment in the case of winding up of company, then also it is deemed to be a preference share capital. Are we clear on that? Are we clear on that? So Shaurya is asking me, ma'am, do preference share receive premium even when there are losses? So well, it depends on the terms and conditions under which preference shares have been allotted, firstly. Secondly, if the premium has been prescribed in the MON and the AOA, it needs to be paid. It needs to be paid. So company will have to figure out its way to pay the premium, right? Are we clear on the deemed preference capital? Are we clear? So basically, deemed preference capital speaks about the situation where the preference share capital has a right to participate in the surplus profit or has a right to surplus asset. So if the preference share capital comes with this right, then also it comes with this right or not, it will be deemed to be a preference share capital. Is that clear? Okay, so if we try to sum up the preference share capital as such, so Ritik, okay, I'll repeat few more points. First point, I'm talking about exemption in section 43. So exemption in section 43 to private company is that private company can have a variation in its share capital, right? But so the share capital of the private company will be dependent on what is written on the MOA and AOA of the company. It could be that a private company comes with equity share capital only, it doesn't have a preference share capital. So in case of private company, they are free to decide on how they want to structure their share capital. But and there they will be governed by the memorandum or articles of association of the company. So we know that as such, the company is governed, a private company is governed by Companies Act 2013, but there are several areas where a company has a right or the memorandum or the articles of association overrules the Companies Act. So it is one of the situation where the memorandum or articles of association overrules. So if the MOA and AOA of the private company says that section 43 will not apply on them, it will not apply. But they can claim this exemption only when they have not committed any default in filing of its financial statement, right? Now coming to the point where we were talking about deemed preference share capital. So we know as a preference share capital, you have a preferential right to dividend and a preferential right of repayment in case of winding up of company or repayment of capital, right? Now we are talking about deemed to be preferential capital. So the explanation says that if whether the preference share capital come with any of these two rights or not, it will be considered to be a preference share capital only. So whether the share capital that we are talking about has a right to participate in surplus profit or has a right to participate in the surplus asset, whether they have these rights or not, they will still be considered as a preference share capital, right? So as a preference shareholder, you always have the first right to payment of dividend and first right to repayment in case of winding up, right? But so let's say rupees 100 is the total amount available for dividend for the company, right? 50 is supposed to be paid for 70 is rupees supposed to be paid for PSC, and 20 is supposed to be paid to equity, right? Right? Now, still we have rupees 10 left. So when 100 rupees there, firstly 70 rupees will be paid to PSH, which is preference shareholder. 20 rupees be paid to the ESH. What is left behind? Rupees 10. So here we are talking about a right where preference shareholder can equally compete with equity shareholder on this surplus profit. So the explanation says whether the preference share capital comes with the right to participate in this surplus profit or not, it will be deemed to be a preference share capital. So if the preferential right to dividend is there, it is a preference share capital. If there is a preferential right to repayment of the amount, it is a preference share capital. Is that clear? Is it similar to debenture? Shraddha, your question is not clear. I'm sorry, I couldn't understand your question. Is this concept clear now? Deemed preference share capital? So if we try and sum up, so PSC, when we talk about dividend, they have a fixed rate or the fixed amount. In case of winding up, they have preference of repayment over equity, and they may come with a right to participate in surplus profit or asset. Now, these are optional rights. Even if they come or they do not come with, if they come with these optional rights, then also they will be deemed to be a preference share capital. Is this right? Dikshit is asking me, ma'am, why were there no differential equity shares before being issued by Tata Motors for the first time in 2000, while the normal equity shares were issued for the first time issued in 1783? Because the answer to this is, Dikshit, because the DVRs was first introduced somewhere in 2000 in the Companies Act 1956. So in the older Companies Act and pre-2000, we did not have a concept of equity shares with differential voting rights. It was only in 2000 where through an amendment, the equity shares with differential voting right was introduced in the Companies Act 1956, right? And now they have become a part of Companies Act 2013 also. But when we will go through the 2013 provisions, you will see that recently there has been amendment on issuing of share with differential voting rights. So earlier it was 26% of the 26% of the total share capital. Now it is 74% of total voting power or something like that. We will go through that. Don't worry. So as of now, are we clear with this part? Deemed preference capital and the basic concept of preference capital. Are we good here? Now coming to the equity share capital. No, Vishnu, this concept of deemed preference capital is not for protecting the right of preference shareholder. It basically tells you whether a share capital comes with where the preference share capital comes with the right to participate or in the surplus profit or not, it will be still deemed to be a preference share capital. So this right to participate in the surplus profit or surplus asset is an optional right. Whether these rights are there or not, a share capital which has a preference on the payment of dividend at a fixed rate or amount, or they have a preference right in repayment of capital, they are a preference share capital. Yes, Satish, even without explanation 3, you treat preference share as preference share only. But when we talk about preference share, they are of two types. They are participatory and non-participatory. So through this explanation, it is trying to say that non-participatory will be also deemed to be a preference share. So the participatory preference share capital people have a right to participate in the surplus profit and assets, right? So the ones that are non-participatory, even they are preference share capital only. Don't try to put in too much of brain, because too much of brain putting can confuse you to the core. And then probably you will have to sit with a Ramaya and continue reading all the case laws to will have to develop a clear understanding. So all you need to understand what is a deemed preference share capital. So is it clear now? Should I proceed? Ram Prakash is asking me, ma'am, what is surplus assets? So what happens if the company is going into liquidation or it is going into winding up? There are people who are to be paid. They are the creditors of the company, right? So they are paid first. After paying all the creditors, there might be some assets of the company that is left behind. For example, the office is sold, the office furniture is sold, the profits that was there with the company that has been given, the factory is sold. However, still there is a piece of land that was owned by the company that is left behind. So that asset that is left behind, it is still worth some money. So that asset, when it is sold, the money that is generated through it both the equity and preference share capital people can compete for it. So this is what is left behind: surplus asset, the asset that is left behind after payment of all the creditors of the company. After everybody is paid, whatever asset is left behind, that is called the surplus asset. Will it be fine if we interchange the word specified and prescribed while writing the answer? Well, prescribed really means, well, you can. It doesn't really make a lot of difference. You can. No, Janki, you are misunderstanding this concept of surplus profit or asset. So explanation 3 said the capital will be deemed to be preference share capital whether or not it has either or both of the following rights. So whether or not it has either of, or both of the following rights, it will be deemed to be a preference share capital. What are these rights? Right to profit and surplus profit, and right to participate in surplus asset. These are the 2 rights. Okay, is that clear? Okay. Nandish, Varan, I am trying to use maximum number of example, but sometimes even I don't know how to present it to you so that you guys are able to understand it. Anyways, proceeding on to the equity share capital, right? So when we talk about company limited by shares, equity share capital is the which comes with the equal voting right. So when you try and understand, equity shares are one of the main sources of the fundraising for the company. So let's say when you go for funding to an angel investor, what does he do? He gives you his expertise, his knowledge, and money in return of equity in the company, right? So there is an equity dilution. When there is an equity dilution, there is a dilution of control over company as well. Why? Because equity comes with voting rights. When your voting rights are diluted, your control over the company also is diluted. So if you are a majority equity holder, you are a majority shareholder, then you have a right to make all the majority decisions of the company. So let's say a company is incorporated as of now, where 75% of the shares or 78% of the shares are together held by the husband and wife. They can take all the majority decisions of the company, because if we go by voting, any which ways they can pass 3/4 of the share votes, right? But when they go for raising funds, they will dilute their equity. When there is dilution of equity, there is dilution over the control of affairs of the company. So there is a business risk associated also. So you will see in a lot of cases, it happens in startups, that startup is a company started by somebody else, but eventually that person himself is just a minor, and the company is ends to be in control of somebody else. So he ends up leaving the company, because when you do not have the control of over the company, you are not able to participate in the decision in that authority. This is why the concept of DVRs were introduced, which is differential voting rights. So differential voting rights usually come with a higher dividend and lesser amount of voting rights. So through this, what happens, that the people that the funding is also raised, but the control over the company still remains with the promoters of the company, or people who are interested in the functioning of the company. So it is a very good way of raising money without diluting the control over the company. Is that clear? Is that clear? No, Shubham, preference shareholder is not a creditor of the company. Creditor, we can say the debenture holders are in a way the creditors of the company. Preference share capitals holder are not the creditor, but they have a right to a fixed amount of dividend. Yes, you are right, Shaurya. Dilution means to lessen. Now, speaking about the equity share with the differential voting rights, to which we also call the DVR, right? So you often get to see the word DVR. So this concept of equity voting rights with DVRs, it was only introduced in the later half of Companies Act 1956. So it was somewhere in 2000 when this DVR rights were introduced in the Companies Act of 1956. It was introduced in section 86. But later on, it became a part of Companies Act 2013 also. So that time in 2000, I think Tata Motors Limited issued 10 DVR equity shares with a dividend of 5%. So what happens in case of DVR, that you generally see that the rate of dividend that is available to a DVR is higher than the rate that is available to the equity shareholder, not with regular voting rights. Because they have a higher rate of dividend, their voting rights are reduced. So maybe on 10 shares, they have 1 vote instead of 10 votes on 10 shares. So this is what is understood by equity shares with differential voting rights. Now, there are certain requirements for issuing equity shares with differential voting right, and that is provided for in Rule 4 of the company's share capital and debenture rules. So what are these conditions that are to be fulfilled? So Rule 4 says a company limited by shares may issue equity shares with differential rights as to dividend, voting, or otherwise if it complies with the following condition. What is the first condition? The first condition is the article of association authorizes. So there is a authority in the AOA of the company. A, right? So there is an authority in the AOA of the company. So if there is no authorization in the AOA, a company will not be issue shares with the DVR. So the articles of association of the company should permit that a company can issue equity share with differential voting right. Correct? Now proceeding. The issue of share is authorized by an ordinary resolution. So what kind of resolution needs to be passed here? Ordinary. So we have got O, we have got A. O stands for ordinary resolution and A stands for authorization in the articles of association. So point B says the issue of shares is authorized by an ordinary resolution passed at a general meeting of the shareholders, where the equity shares of a company are listed on a recognized stock exchange. So here we are talking about listed public companies. So where their equities are listed on a recognized stock exchange, the issue of such shares shall be approved by shareholders through postal ballot. So in a normal course, authorization by ordinary resolution is enough. But where the shares are listed on a recognized stock exchange, in that case, you need approval of shareholder through postal ballot. Is that clear? So with O, you can also have PB, right? Postal ballot. Now, the voting power in respect of shares with differential rights of the company shall not exceed 74% of the total voting power, right? So in totality, the voting power then that can equity share with DVR hold is 74%. It cannot exceed 74%. So the total voting power that can be associated with equity share capital with differential voting right is 74%. So V is 74. So probably this will help you remember. So you can write it this way: O by PB, A, V by 74. This will be helping you in remembering the conditions for issue of differential voting right. Is that good? Further, the company has not defaulted in filing financial statement and annual return for 3 financial years immediately preceding the financial year. 3F. So for 3 years, it should not have defaulted in filing financial statement and annual return. Correct? Further, the company should not have subsisting default with respect of payment of dividend. So it should not have defaulted. There should not be a default in the payment of dividend or repayment of the matured deposits or redemption of preference share that have become due. So what happens whenever a company takes a deposit from the exterior party, that deposit comes with a timeline, right? So when it becomes mature, the company has to repay it. Similarly, the preference share also has a life. The preference share, the maximum life of preference share is 20 years. So they come with a fixed lifeline. They expire. So after that time period is over, they are supposed to be redempted. Now redemption will be done either at a premium or at the same price. That will be governed by the MOA and AOA of the company, right? So the company should not have defaulted with respect to payment of declared dividend, repayment of mature deposit, or redemption of preference share or debenture that have become due. The next requirement is the company should not have defaulted in payment of dividend on preference share or repayment of any term loan from a public financial institution. So it should not have defaulted in repayment of loan also that was taken from public financial institution or scheduled bank, or any due which are there with respect to statutory payment relating to the employees, or default in crediting the amount in IEPF. So these kind of defaults should also not be there. So and the next requirement is that the company should not have been penalized by court or tribunal during last 3 years for offenses under RBI Act, SCRA Act, FEMA, or any under special act. So if these defaults are not there, the company will be able to issue equity share with differential voting rights. However, where we were talking about default in payment of dividend, etc., in that case, if the company has defaulted also, but it's been already 5 years in which the default was made good, then it can proceed with the issue of equity shares with differential voting rights. Are we good here? Are we good here? Aditi, in surplus profit, who will get money first will depend on, they both will be allowed to compete, and how the payment will be done, that will be governed by the AOA of the company. They both have a right to compete. I am repeating the conditions for the issue of equity shares with differential voting right. So firstly, let me explain again what is DVR, because some students are having confusion. So generally we know, if a person has equity shares, one share, one vote is the general principle. So if I have 100 shares of the company, I have 100 votes generally. But there are certain shares which come with reduced voting right and a higher dividend. It is done so that the promoters of the company, the stakeholders of the company, are able to maintain control over the company, but still they are able to raise fund as well. So in case of differential voting right, what you will see, the amount of dividend that is paid to a equity share with DBR will be higher than what it is paid to the equity share capital person, equity shareholder. But the voting right will be less. So maybe it could be that for 10 shares, if I own 10 shares, I have 1 vote instead of 10 votes. So this is what is known as differential voting right. There is a difference. There is a variation in the voting rights. So under the Companies Act, under Section 43 of the Companies Act, it is permitted to issue equity shares with a differential voting right. Right? So differential voting right will be a reduced voting right. So when Tata Motors issued their DVR shares, they said for 10, the dividend was higher. So it was 5% for DVRs. So it was higher than what was paid to the equity shareholder. But voting rights were 1/10 of that of a equity shareholder. So this is what is understood by equity shares with differential voting right. Now coming to the conditions. What are the conditions to be fulfilled for a company to be able to issue a equity share with a differential voting rights? There are certain requirements that have been prescribed in Rule 4 of Company Share Capital and Debenture Rules, correct? Now, what are the prescription? The first requirement is authorization in the article of company. So OA 74. A stands for authorization in the article of the company. O stands for passing of an ordinary resolution. So the issue of equity share with the DVR should be authorized by an ordinary resolution. But there is an exemption here where the equity shares of the company are listed on a recognized stock exchange. In that case, the shareholders will have to approve the right, or will have to approve the issue of equity share with the DVRs by postal ballot, right? So OAPB. Now, the voting power in respect of shares, so the shares that you are allotting with differential voting right, the total voting power that can be associated with such shares cannot be more than 74% of total voting power. So what is the maximum total voting power that can be associated with DVRs? It is 74% of the total voting powers, which include voting power in respect of equity DVRs that were issued any point of the time. So over the life of the company, at no point of time can the voting power associated with DVR be more than 74% of the total voting power. Is that clear? Guys, Apurva, are you clear with point B and point C? Vaishnavi, your voting right will be in proportion. You will not have one vote. Your vote will not be considered as one vote. It will be considered as 0.6 vote. But generally, such kind of conditions you do not see. People subscribe the shares accordingly. But it will always be in fraction. You will be considered, your voting will be considered in fraction. Are we clear on this? Now coming to the next point. So the mnemonics here is O by PB, A, V by 74, right? Now coming to the concept of 3F. So for 3 years, the company should not have defaulted in filing financial statement annual return for 3 financial years that are preceding to the issue of DVRs, right? Vaishnavi, if you have 6 DVRs, you will have 6 votes. So O by PB, A, V by 74, 3F. So for 3 years, it should not have defaulted in filing financial returns. Other than that, the company should not have defaulted with respect of repayment. Repayment of what? Deposit, dividend, preference shares, and debentures. DDDF, triple DF. So no default in payment of deposit, dividend, debenture, and preference shares, right? 3 Ds and F. There should not be any default. Also, there should not be a default in repayment of any loan. This loan could be from a public financial institution. It could be from a state level financial institution. It could be from a bank. Also, there should not be any due on interest that are payable on them. Also, the amount relating to statutory payment to the employees or to any authority in default should not be defaulted, nor there should be default in crediting the money to the Investor Education and Protection Fund, which is IEPF. So these kind of default is not there. However, if any of these kind of default has occurred, the company still has a right to issue the DVR if it's been 5 years since the default was made good. So let's say, what do you understand by the term default was made good? Let's say on 21st February 2021, you are supposed to pay make repayment of matured deposit. Instead, you made it on 21st February 2022. That means the default was fixed, it was rectified. You were supposed to make the payment, you did not make it. There was a default which you fixed it in the next year. Now, after the expiry of the financial year, that financial year end will end on 31st March 2022. From that, if 5 years has been lapsed, then in that case, the company will be allowed to issue the DVR. I think Cameroonesa, you are looking at the old study material. Now this requirement of distributable profit of 3 years has been guys, all these people who are talking about 26% total paste, you are looking at old edition of the study material. There has been amendment. Please pick up the new study material. All of you are looking at the wrong study material. That is why you are getting confused. What I am teaching here is with the amendment that came in 2020. So please come here. Further to this, when we talk about 3 years, we also talk about penalization. So for 3 years, companies should not have been penalized by court or tribunal under any offense of RBI Act, SEBI Act, SCRA or FEMA Act. So these are the requirements that are to be fulfilled for a company to be issue equity share with differential voting right. So if you look here, I have included here that there have been a relaxation of norm, a cap of 26% of post issued paid up capital has been raised to 74% of total voting power in respect of share with DVRs. This is why you are not able to see the 0.26% that you are talking about. Shaurya, we will be talking about IEPF in the upcoming sections. In the upcoming classes, it is a part of your syllabus. So as of now, you need to understand it is an Investor Education Protection Authority fund of central government. It's a fund of central government, right? Point C. Let's say when we are talking about it should not exceed 74% of total voting power. So let's say 10 DVR has 1 vote, right? Total votes that are available in the company are 100 votes and 10 DVR is equal to 1 vote. So what is the maximum number of shares that can be issued with differential voting right? 740 shares, right? Because 740 shares will bring in 74 votes and the voting power cannot exceed 74% of the total voting power here. In the ordinary resolution, majority is more than 50%. Yes, the Vaishnavi, you are right that the DVR holders can easily influence the majority. But in that case, you would generally see that DVR holder is not one person. So that voting rights would be distributed. So the entire set of DVR holder, they will come together to vote in favor or against a resolution is a very, very rare scenario, right? So the number of people that would be associated here would be really large. And the companies will always ensure that they have the control in their hand. Debentures, we will discuss only when we are talking about debenture, guys. Please don't pick up debentures as of now. Please try and understand conditions for issue of DVR. It is a very important point and you get to see this in questions all the time. So please pay attention here. Don't wander here and there. Now coming to for the few more points that have been provided in Rule 4 of share capital and debenture rules. So we have seen that we need an authorization wherever DVR has to be issued. So Rule 4 states that the explanatory statement which is annexed to the notice of general meeting or of a postal ballot shall contain various matters like particulars of the issue, including its size, detail of differential right, etc. So we always know whenever the explanatory statement goes with the notice of the meeting of AGM, the details, the explanation of the decisions to be taken are included so that the people who are supposed to vote can make an informed decision. Prakash, your question is not clear. Further, there is a restriction on conversion of equity share capital with voting rights into equity share capital carrying DVR. So, as per Rule 4.3, a company cannot convert its equity share capital with voting right into equity share capital with differential voting right, nor can it convert equity share capital with differential voting right into equity share capital of with voting right. So the numbers have to be predetermined in the AOA of the company. Also, there is a requirement for disclosure in the board report. So whenever the company issues DVR, share equity share capital with the differential voting right, then there has to be a disclosure in the board report specifying the details of the DVR, like to whom the DVR was issued, what are the numbers, all these things have to be given for. So as such, the people or holder, the equity shareholder with DVR, they enjoy all the right of the holder of equity shares, like the right to bonus share, right share, etc. It's just that they have certain differential right pertaining to voting or the dividend. So as such, equity shareholder with DVR also have a right to bonus share or the right share. These rights are not killed except certain variations that are prescribed for. Okay. Now, the register of members has to be prepared here, where the list of the equity shares with differential right on who are the people who own the DVR, that detail is included in that member. So this register of members and the detail of it we will talk about when we read the section 88. So this was all about the equity share capital with DVR. Is that clear, guys? So I will quickly repeat the requirements for or legal requirements for issue of equity shares with DVR. First is issue of shares should be authorized by the articles of the company, right? Then it has to be authorized by passing OR, or where the shares are listed on a recognized stock exchange, it has to approved by passing of OR through postal ballot, right? Now, the voting power in respect of share with differential right shall not exceed 74% of total voting power. Third requirement is the company should not have defaulted in filing financial statement annual return for immediately preceding 3 financial years. Plus, the company should not have subsisting default with respect to payment of dividend, payment of deposits, payment of debentures, payment on redemption of preference shares, or they should not have defaulted for repayment of term loan from a public institution, dues with respect to statutory payment relating to employee, and crediting the amount in investor education and protection 1, right? But if there are default pertaining to the payment of dividends or payment of term loan, in that case, they can issue the shares if it's been 5 years since the default has been made good. Also, the company should not have been penalized during the last 3 years for offenses under RBI Act, SEBI Act, SCRA Act, FEMA Act, or any other special act, right? So these were the requirements for issue of equity share capital with differential voting rights. Is that clear? So differential voting right is nothing but a varied right, a reduced. So now this right will be reduced or increased, that will depend. So generally what we have seen that equity share with differential voting right come with a higher dividend but lesser votes. Prakash, I just gave the example of concept of expiry of 5-year default. So let's say you were supposed to make a repayment of loan, or you were supposed to pay for the mature deposit on 21st February 2021, right? You did not make a payment on 21st February 2021. That means there is a default. However, on 21st February 2022, you made the payment for this mature deposit, correct? That means default has been made good. It has been rectified. There was a default which you have fixed, right? Now, since the default has been fixed, 5 years should have been passed. 5 financial years should have been passed. So when you make the default good on 21st February 2022, the financial year will end on 31st March 2022. So from 31st March 2022, 5 financial years should have been passed. If 5 financial year has been passed, you will be able to issue equity shares with differential voting right. Is that clear, Prakash? Dikshita is asking me, ma'am, what is the difference between prohibited and restriction? Prohibited means you are not supposed to do it. If I say transfer of shares in a private company is prohibited, what does it mean? It means you cannot transfer the shares of private company. Rather, section 2 clause 68 says the transfer of shares of a private company is restricted. So there are certain restrictions, right? Which have to, so they are transferable, but with certain limitations. So during, let's say you are prohibited from entering a mosque. So women are prohibited from entering a mosque in India, right? But you were, when there was lockdown, you were restricted from traveling. Or you were allowed to travel only for essential service during the time hours that were permitted by the government. So prohibition and restriction are different. Is that clear? Is that clear, Dikshita? Okay. Now coming on to the share certificate. So the concept of share certificate, it is provided for in Section 46, read with Rule 567 of Share Capital and Debenture Rules 2014. Now, the notes that I have prepared here for share certificate is by combining Section 46 with Rule 567, because when you look at in your study material, it says, please refer to Rule 567 of study material. Right? So here I have prepared a summary sort of thing, reading Section 46 along with the rules. Now coming to the concept of share certificate. So we know there used to be a requirement of issuing a share certificate whenever the shares are issued in a physical form. So two things that we already know. If the company is a public listed company or unlisted company, its shares have to be in dematerialized form, correct? For private companies, they have an option. They can have a share in physical form or the demat form, right? Whenever there are shares in physical form, the share certificate has to be issued in form SH1, right? What will the share certificate contain? The share certificate, like any other certificate, will contain the name and the details of the person in whose favor the certificate has been issued, the amount that has been paid, the shares to which it relates. These kind of information will be given under share certificate, right? For when the shares are in demat form, the list of or the details that are maintained by the depository is more than enough. So we know that there is a requirement for depository to maintain the details of the ownership of the shares. So the details that are maintained by the depository is the sufficient requirement. But where the shares are issued in physical form, the share certificate has to be issued. Are we clear? Now, coming to the authority to issue share certificate. So the authority comes by a resolution passed by the board of directors. So the board of directors will pass a resolution under which the company will be allowed to issue a share certificate to the shareholders of physical form of shares. Correct? Second point says conclusive evidence. That means this share certificate, which is owned by a person under the common seal of the company, which is optional, it is the prima facie evidence of the title of the person to such shares. So if I own a share certificate in my name for ABC company, it is the prima facie evidence that I am the holder of that share. But the point arises, can we put a conflict to this prima facie evidence? Yes. Every evidence can be challenged, right? So a prima facie evidence, it will be considered that yes, you are the rightful owner, but if the defendant or if the other person proves that the share certificate is mutilated or it is forged or it was stolen, then maybe his rights will be violated. But as such, the share certificate is the prima facie evidence of the ownership of shares. Is that clear? Now, coming to the point, distinctive number of each share. So we know that the share capital of company is broken down into distinctive numbers. So let's say if the share capital of the company is rupees 100 and it has 10 shares of rupees 10 each. So it is broken down into distinctive number and distinctive price. Correct? Now, there are the requirement of signature on share certificate, right? What are these requirements? The share certificate, whether issued under common seal or not, earlier common seal was mandatory. Now it is optional for a company to issue a share certificate under common seal. So wherever the share certificate is being issued by the company, either it will be signed by 2 directors or it will be signed by 1 director and a company secretary where the CS has been appointed. Where the company has a common seal, it shall be affixed in the presence of person who are required to sign the certificate. So if the share certificate comes with the common seal will be affixed in the presence of 2 directors or the director of a company secretary, right? The 4th point says issue of share certificate by OPC. In case of OPC, it will be sufficient if the share certificate is signed by 1 director and the company secretary or any other person authorized by the board for this purpose. So for OPC, the requirements are very, very low. I think I've put an error here. It is, I'm sorry. It will be enough if this, in case of OPC, it will be enough if the share certificate is signed by 1 director or the company secretary, not and. I think there is an error here. If you have my presentation, you can fix it. It's or, not and. Or the company secretary or any person authorized by the board for this purpose. Prima facie evidence. What is prima facie evidence? Okay. Prima facie evidence is the first hand evidence which on the face makes the ownership clear. So let's say you buy a piece of land, right? But the papers of registry under which you buy the piece of land, it is in the name of your mother. So who is the right prima facie on the face of it? Who is the owner of the land? Your mother, even though money was paid by you. So on the face of it, on the papers, who appears, the first hand evidence is called the prima facie evidence. Yes, Sumit, only points related to section 46 are there in the module. But when you look at the bottom, at the footnote, you will get to see it has mentioned that you have to refer to rule 4, 5, 6 and 5, 6 and 7 of the share capital and debenture rule. That is why I have prepared this summing up the section and the share capital and debenture rule. Guys, this presentation is already uploaded on ICAI portal, so don't worry. Further, how do the doctors sign the share certificate, right? So where there is a facsimile signature of the director, right? Even then it will be deemed that the director has signed. So this facsimile signature is induced by by through machine or through stamp or through equipment, or if it is digital signed, then also it will be deemed that the director has signed the share certificate. Further, maintenance of share certificate form, related book and documents. Now, the forms of share certificate, the related book and documents have to be preserved by the company, right? So, what are the requirements for this have been provided here. So, the rule says all blank forms to be used for issue of share certificate shall be printed, and printing shall be done only on the authority of a resolution of the board of directors. So we know that share certificate has to be issued in form SH1. These forms have to be printed, and the printing has to be done on the authority of the resolution of the board of director. Further, the blank form, they have to be numbered. So in serial wise, there have to be numbering. And the forms and the blocks, the engravings, the facsimiles and the hues relating to the printing of such form. The blank form that are printed, they will be kept in the custody of the company secretary or any person who has been authorized by the board. And this person who has been authorized, he will be responsible for rendering an account of these form. Rendering an account of these form means लेखा जोखा देना पड़ेगा. 10 फॉर्म आए थे, 4 अलॉट हुआ, 2 बच गए, किसको अलॉट हुआ, किसको इशू हुआ. There has to be an accounting on how many forms were printed, how many were used, how many were not used. All this has to be given. ठीक है. Further, the committee of the board of directors or appointed company secretary or duly authorized director shall be responsible for the maintenance, preservation and safe custody of all books and documents relating to share certificate, including blank form of share certificate. Why is it important? If the blank forms are stolen, false, furgy share certificate will be issued. And you remember there have been scams, major scams that has happened because of this. So yes, even the stamp paper scam was somewhere like this only. So it is the responsibility of the board of directors or appointed company secretary or duly authorized director to maintain and preserve these documents in safe custody. Preservation of books and documents relating to issue of share certificate. Now, these books and documents have to be preserved for at least 30 years, right? Also, the certificates which are surrendered to the company shall be immediately defaced or destroyed by stamping or printing the word cancel in bold letters and may be destroyed after the expiry of 3 years from the date it was surrendered. So 2 points, the documents relating to shares have to be preserved for a period of at least 30 years. But in disputed cases, they can be preserved permanently. Third point, the certificates which are surrendered to the company will be immediately defaced by putting a stamp of cancel, and they will be destroyed after a period of 3 years from the date on which they are surrendered. And this destruction of a share certificate will be done under the authority, which is under the authority of resolution of the board of director and in the presence of duly appointed by the board of directors. So the person who has been duly appointed for this purpose, in his presence only, the share certificate will be destroyed. Is that clear? So we know that share certificate is a conclusive evidence and the prima facie evidence of the title of the person to such shares. Okay, some people are requesting me to repeat the OPC point. So we know that the share certificates have to be signed. Who are these people who can sign the share certificate? So 2 points are there. Share certificate can be issued under, if the company has a common seal, the share certificate can be issued under common seal. Earlier, common seal was mandatory. Now, common seal is optional, right? First point, the share certificate has to be signed. As a regular procedure, it can be signed by 2 directors or by 1 director and the company secretary, where the company secretary has been appointed. Where the company has a common seal, the common seal will be affixed in the presence of the people who are required to sign the certificate. That is 2 directors or a director and a company secretary. Where the company is a OPC, in that case, the share care certificate will be signed by either by the director or the company secretary or any person who is authorized by the board for this purpose. So the person who has been authorized to sign the share certificate, that person can sign the share certificate in the case of an OPC. Is that clear? Now, so this it is considered that the share certificate has been signed by the director if the signature has been affixed through a machine, equipment, or any other mechanical means. It is not mandatory that a person, the director, will have to take the pen and sign every share certificate. Trust me, it is not possible. So maybe for smaller companies where there are 3, 4, 5 shares, 10 shares, 100 shares, maybe they can. But the number of shares that you get to see in a company is in thousands and lakhs. So it is not possible for a director to sign every share certificate. So if the shares, the signature of the director, if it is affixed by means of a machine or equipment or any other mechanical means, it will be deemed that the director has signed the share certificate. Virendra, I don't know as such why the shares are destroyed only after expiry of 3 years and not immediately. The reason being, there could be a situation where there have been some forgery, some loss of share certificates, right? So it is preserved for a certain period of time. So let's say if somebody else's right is violated, he can come up and say that I have lost the share certificate, or there could be some dispute pertaining to share certificates. So this is why they are preserved for 3 years and only then destroyed. Destruction means this: tear it off. It is put in the machine and destroyed. No shares cannot be surrendered where the money is unpaid on the share. So further, whenever a company is issuing the share certificate, they have to comply with certain condition with respect to issue of renewed or duplicate share certificate. These rules are provided for in Rule 6 of the Companies Share Capital and Debenture Rules 2014. Now, what does Rule 6 says? So wherever there is a issue of a renewed or a duplicate share certificate, the requirements are laid down. What are these requirements? In case of subdivision, consolidation, or replacement, the duplicate share certificate shall be issued after original share certificate is surrendered to the company, right? So wherever a new share certificate is being issued or a duplicate share certificate is issued, in case of subdivision, consolidation, and replacement, and if the share certificates are defaced, mutilated, torn, old, decrepit, worn out, in that case, the old share certificate will be surrendered to the company. So for issuing the duplicate share certificate, the company is allowed to charge certain fees, and they will have to make necessary reference to that old certificate on the face of fresh certificate and in the register of members. So the numbers or a referencing has to be done so that we know this is the duplicate certificate of that original certificate. Also, prior consent of the board of directors and a payment of minimum fee is required for issue of duplicate share certificate in lieu of certificates that are lost or destroyed. So it is important that the board of directors approve the issue of the duplicate share certificate. Also, wherever the board of directors give the permission, they also demand supporting evidence and they claim indemnity and out-of-pocket expenses incurred by the company in investigating the evidence produced. Now, why it is done? Let's say I have the share certificate that was stolen, or maybe I have a share certificate. Some other person goes to the company and says that, hello, I have lost my share certificate. Please issue me new share certificate or a duplicate share certificate. So what will happen? In that way, there will be a conflict on the ownership of the shares. That is why we have a provision of indemnity. So in case there is a duplicate share certificate issued and somebody comes up with the original share certificate, the rights will be protected, right? So are you able to understand this concept of indemnity here? Now, maintenance of register of renewed and duplicate share certificate. So whenever company issues a renewed or a duplicate share certificate, there will be an entry in the register with cross-referencing in the register of members. And these registers are kept at the registered office of the company and they are preserved permanently and kept in the custody of the company secretary or the person who has been authorized by the board for such purpose, right? And whatever entries are made in this register, these entries are authenticated by the company secretary or the person authorized by the board for such purpose, right? So okay, I'll repeat the indemnity concept, Vaishnavi. So you need to understand what is the meaning of the word indemnity. Indemnity means to make good the losses, right? Let's say I have a share certificate for 10 shares of Reliance Company. I lost that share certificate, right? I went to the company and said, see, I have lost my share certificate. Please issue me a duplicate share certificate. Okay. So company will say, please give me the evidence that you have lost the share certificate. So I'll say, okay, this is the FIR of the loss of share certificate. There is no way that loss of share certificate could be really investigated, correct? Or let's say my share certificate got damaged due to flood in my house or due to fire or some other reason. Then later on, somebody else comes and claims that the duplicate share certificate was incorrect and Mr. B is the actual owner. In that case, the rights of Mr. B has to be protected. So if Mr. B is the actual owner, he will have to be indemnified for the losses that he has suffered. So this is the concept of indemnity here. Okay. Okay, so what if there is a issue of duplicate certificate with an intent to fraud? So the word intention is here, where a company deliberately with an intention of fraud issues a duplicate certificate. In that case, the company will be punishable with a fine of not less than 5 times the face value of the shares, or which can extend to 10 times, or rupees 10 crore, whichever is higher. So the penalty is very heavy for issuing duplicate certificate with the intent to fraud, and every of the officer of the company who is in default shall be liable for action under section 447, which is the section for fraud, right? Now there are certain timelines for the issue of share certificate. So unless it is prohibited by a provision or any order of court or tribunal, generally the share certificates has to be issued as per the following timelines: to the subscriber of memorandum within 2 months from the date of incorporation, to the allottees within 2 months from the date of allotment, to the transferee within 1 month from the date of receipt of instrument. So what is the difference between the allottee and transferee? Allottee is the person who made an application for allotment of shares during the IPO and the FPO, and the shares were allotted to him. So in that case, the share certificate has to be given within 2 months of the date of allotment. Transferee is the person to whom the shares are transferred under a deed of transfer. So under an instrument, the shares are transferred. So supposedly, there is a auctioning of DDA flats, right? So this government flats, they are auctioned. So let's say I have participated in the auction and I put in my perchi for that auction and I was chosen, right? Not really, there is a lucky draw of the DDA flats. So my name came out and I was allotted the DDA flat. Now, 10 years down the line, I transfer under a deed of transfer that DDA flat to Mr. X. So this is not the allotment, this is the transfer under a legal instrument. So where there is a transfer of shares, the transferee will be issued the share certificate within 1 month from the date of receipt of instrument of transfer. To allottee of debentures, it will be 6 months. Right? What was your doubt, Aditi? Aditi, ma'am, can't we have our original certificate laminated and have a copy it in our hand instead of issuing duplicate share certificate? Firstly, the duplicate share certificate is issued by the company. It is the original certificate that is issued to the shareholder. It is the responsibility of the shareholder to keep the share certificate safe. But just in case if the share certificate is lost, mutilated, torn, worn out, defaced, he can apply for a copy of a duplicate share certificate. But there are certain requirements that will have to be fulfilled for issue of a duplicate share certificate. A lot of times, let's say you have kept your share certificate safe, laminated and everything. There was a fire in your house and your bookshelf got burned. In which bookshelf? The file in which you had kept the share certificate. Then what? Would you not need another share certificate? So there are situations where a duplicate share certificate could be needed. For students who are asking me to explain ordinary and special resolution, when we talk about meetings, I will deal with ordinary and special resolution in detail, not as of now. But you need to know that ordinary resolution is passed by simple majority, that is more than 50%, and special resolution is passed by 3/4 of the majority. Is that clear? So whenever a share certificate is issued by unlisted company, they have to be issued within 3 months from the date of submission of complete documents with the company. And in case of listed companies, the duplicate certificate has to be issued within 45 days. So these are talking about the timelines for duplicate share certificate. Correct? Are we good till here? So a lot of students are asking for break. We can take a 2-minute break here. In the meanwhile, I'll go through your queries. If I have missed anything till here, I will pick up those queries and then we will start with the voting rights. Okay. Guys, welcome back. Break time is over. Taking up your queries, I have received from Lalita ma'am. Now, Demat account is used for shares, and is there the physical copy concept in reality? Yes, Lalita, you're absolutely right. With the passing time, the concept of share certificate is becoming redundant, but you need to understand for the private company, it is still optional to have shares in a physical form or Demat form. For public company, for listed or unlisted, they need to be having a Demat form. And also for unlisted public company, we saw about situations where they have to convert the physical shares into the Demat form. But for private, we still have the option of physical form. That is why we need to understand the share certificate. Satish, you were unable to find the timelines for issue of share certificate because it is not given in the study material. I have prepared it on my own for you guys. Transferee, Prakash, yes, you are right. Transferee owns existing share from a shareholder and allottee gets a new share from the company directly. Yes. Virendra, the documents that are required to be filed, submitted to the company to issue share certificate would be generally the FIR or the complaint pertaining to the loss of share certificate. You will submit an affidavit, plus you submit an indemnity bond. So all these documentation are submitted, and then new share certificate is issued. Okay. Shore is asking me, ma'am, only company limited by shares may have DVR. Yes, dear, because for issuing equity share with DVR, you should have a share capital. In that share capital, there should be equity share capital, and it should be permitted in AOA to issue equity share with DVR. So it's not just that it has to be company limited by shares only. It should be permitted in the AOA of the company to issue equity share with DVR. If the permission is not there, you will not be able to issue equity shares with DVR. Okay, are we good till here, guys? Now, coming to the voting rights. So this is the next section that we pick up where we talk about the voting rights. However, before we proceed on the voting rights, I will briefly tell you about the difference between preference and equity share, because this is one area where students often ask questions to me. So when you look at preference share and equity share, I have not drawn the table here. I'm just telling you the points. If you want, you can mention it. But if you have understood preference and equity share, you will be able to understand it. Okay. Now, coming to the difference between the preference and equity share. So if you look at from the definition point of view, preferential shares carry a preferential right to payment of dividend and repayment of capital, right? Equity shares, all the other shares are called the equity shares, correct? Now, in case of preference shares, the dividend is paid on priority. So first the preference shareholders are paid the dividend, and if anything is left behind, it is divided amongst the equity shares. Secondly, in case of preference share, the amount or the rate at which the dividend will be paid is fixed. In case of equity, the profits of the company after payment to the preference shareholders is divided to the equity share. So how much dividend an equity shareholder will be given, it depends on the amount of profit that is left behind. Correct? Now, at the time of winding up, firstly, the repayment of capital is made to the preference shareholder. If something is left, it is repaid to the equity shareholder. In case of voting right, preference shareholders have voting right only for voting for matters which affect them. So what are the voting rights that we are just going to do now? But what you need to understand, as such, they do not have a voting right except for matters that have been specified in section 7. Whereas when you talk about equity shares, the holder of equity shares have voting right in every general meeting and for every matter. When you talk about redemption of shares, preference shares are always redeemable. There is no way that irredeemable preference shares could be issued, and they come with a fixed lifeline. So the maximum duration within which the preference shares can be redeemed is 20 years. However, there is an exception of infrastructure projects where it could be 30 years. But the preference shares as such come with a timeline. Similarly, equity shares are always irredeemable. That is, companies cannot redeem the equity shares during its lifeline. So you need to understand the meaning of redeem. So let's say you were given a voucher by Maurya Sheraton of food worth rupees 2000 rupees. So how will you redeem the voucher? You will go to the restaurant of Maurya Sheraton, order your food, and if your bill is 4000 rupees, rupees 2000 will be deducted. So this is called redemption. So, but the equity shares are irredeemable, but the preference shares are always redeemable, right? Now, the equity shareholders have a right to bonus and right shares, whereas the preference shares holders do not have a right to right issue or a bonus issue. Equity shareholder with DVR, they also have a right to bonus issue or a right issue, right? Now, in case of accumulation of dividend, it will depend on what kind of preference share is. If it is a preference, cumulative preference share, its dividend will be accumulated. And if it is a non-cumulative preference share, the dividend will not be accumulated. But in equity shareholders case, they are not entitled to any fixed rate or amount of dividend. If a dividend is not declared in any year, their dividend will lapse and they will not get any money or dividend as a right. Is that clear? Students are asking me, ma'am, where are the PPTs uploaded? PPTs are uploaded on the students portal, right? From where you log in for your examination, I think. But still, I will confirm with the technical team of ICAI and confirm where are these PPTs uploaded. Okay? Don't bother on it. Even which ways you are going to get this PPT. Don't worry about it. Focus on what I'm talking, right? So, is everybody clear with the concept of preference and equity shares? Right? Should we proceed on the voting rights? Okay, now coming to the concept of voting rights. So, in case of voting right also, we will study in under two headings: voting right of equity share capital holders and voting right of preference share capital holder. So, the voting rights have been provided for in section 47. So, section 47(1) says that subject to the provisions of section 43, section 52 and section 188(1), every member of a company limited by shares and holding equity share capital shall have a right to vote on every resolution placed before the company. So, people holding the equity shares of a company have a right to vote on every resolution that is placed before the company. And whenever the voting is done on poll, his voting right on a poll will be proportion to his shares in the paid up equity share capital. So if there are total 100 if the paid up share equity share capital is 100 CR and he owns shares worth 10 CR, so his voting right will be 10%, right? So his voting right will be in proportion to his share in the paid up equity share capital of the company, wherever it is being done on a poll. Prakash, equity shares are transferable, but they are not redeemable. Yes, you are right, Prakash. They are redeemable only at the time of winding up company. That's actually not redemption. That is winding up and resolution of company. You don't use the word for redemption there. So Bhavya has confirmed that the presentation for download is available on live.icai.org in download presentation section /vcc/intermediate.php. Guys, figure it out. A lot of students know how to download the presentation. Please don't bother me in the middle of the class with the downloading of presentation. Honestly, you guys really break the flow for me. And then when I don't answer, you keep on saying, ma'am, you missed my query, ma'am, you missed my query. Guys, पढ़ना ज़्यादा ज़रूरी है. Presentation download करना इतना ज़रूरी नहीं है. पढ़ लो पहले. Okay, coming back. So we know whenever a person has a equity share capital, he has a right to vote on every resolution, and his voting right on a poll will be proportional to his share in the paid up equity share capital of the company. Wherever we are talking about Nidhi companies, right? So section 47(1) will be applicable, subject to the modification that no member shall exercise voting right on poll in excess of 5% of total voting rights of equity shareholder. So this is an exception that you get to see in Nidhi company. So in case of Nidhi company, the voting right of a member will not be more than 5% on a poll. So in case of poll, even though you have, let's say we are doing a poll, you have in general 10% voting right. But you are voting on a poll, you can exercise only 5% of it, of equity shareholder, right? Now, what about the voting rights of the members who are holding preference share capital? Janki, in case of DVR, their voting right will be in proportion to the DVRs. So it will come with the terms and conditions. The way that DVR is structured, similarly, they will have voting right. So in DVR also, any which ways, they have a share capital and the voting associated with it, right? Further, when you talk about voting rights of members holding preference share capital, so the people or the preference shareholders have a right to vote only on resolutions placed before the company which directly affect the right attached to its preference shares, right? Or in case a right to vote on any resolution for the winding up of the company or for the repayment of reduction of its equity or preference share capital. So these are the two areas where the preference share capital holder has a right to vote. First case, where a resolution is placed before the company which directly affect the right attached to preference shares. Secondly, where the resolution has been placed for the winding up of the company or for the repayment or reduction in the equity or preference share capital. In those two cases, the preference share capital holder has a right to vote, and in case of poll also, his voting right will be in proportion to his share in the paid up preference share capital of the company. So we know that the proportion of voting rights of a preference shareholder is in the proportion as to the paid up capital in respect of equity shares. I will explain this to you through this example, proportion of voting right. So have a look here. Suppose a company, please pay attention to this example. You will be able to understand the concept of proportion of voting rights. We will discuss later about notes and presentation, guys. When I'm teaching, you're talking about notes and presentation. Okay, please come to the example now. This will help you understand the proportion of voting rights as you will get confused to the core. So look at this example. So suppose a company has a paid up capital of rupees 150. Okay. Now in this paid up share capital, rupees 100 is the paid up equity share capital, 100 shares of rupees 1 each, and rupees 50 of the paid up preference share capital. So what is the ratio of equity share capital and preference share capital? 2:1. We have 100 shares of paid up equity, and in case of preference, we have 50 shares. So this is the ratio, 2:1, correct? Is this clear? Now, suppose if the company wants to come up with the resolution for winding up. So who all can vote in the resolution for winding up? Equity share capital holder can vote in every resolution placed before the company. A preference shareholder can also vote when the resolution is for the winding up of company. That means both the equity and the preference shareholder can vote on this resolution. right? Now, for example, out of 100 equity shareholders, 90% vote against the resolution. So we have 100 equity shareholders, 90% vote against the resolution, and 10% vote are received in favor. In 50 preference shareholder, 100% vote is received in the favor of resolution. So how do you determine this proportion? So when you talk about 90% voted against the resolution, the effective percentage of equity shareholder against the resolution is 2/3 of this. So it is 60%. Similarly, the votes you have received in favor, it is 2/3 of 10 by 100, which is 6.67%. So you need to see how the, because the equity shareholder comprise 2/3 of the total shareholder, their voting is also in proportion to the shareholding they have, right? So you see the effective percentage of equity of shareholder against the resolution will not be 90%, it will be 2/3 of 90%, which will be 60%. Similarly, 10% voted in favor. So voting weightage will be 2/3 of 10%, which is 6.67%. Similarly, when you look at preference shareholder, their composition is 1/3 of the total shareholder. So the votes that have been received in favor is 33%. So if you look at it, 60% of the total shareholder are against the winding up of the company, and 6.67% plus 30.33%, that is 40%, are in favor of winding up of the company. So this is how you determine the proportion of voting. So proportion of voting. So if you see here, now read here, according to proviso, the proportion of the voting rights of equity shareholder to the voting right for the preference shareholder shall be in the same proportion as the paid up and equity. So the voting rights is in proportion to the proportion of equity and paid preference share capital. जो भी proportion equity और preference share capital का होगा, वही proportion voting right का होगा equity shareholder और preference shareholder का. So here the proportion is 2:1. That means equity shareholder have the proportion of 2/3, right? 2:1 है, 2/3 of the total shareholder, right? So जो equity shareholder है, they comprise 2/3 of the total shareholder, and preference shareholder comprise 1/3 of the total shareholder. So if 90% vote are casted in the resolution against the resolution, so 2/3 of 90 will be 60%. So this is how you determine the proportion of voting right. Is that clear? Guys, is this example clear? Okay. Now, coming to the situation when dividends are not paid to the preference shareholder. So we know that the preference shares come at a fixed percentage or fixed amount of dividend. What will happen when the dividend is not paid in respect of preference share for a period of 2 years or more? In that case, such preference shareholders will have to right to vote on all the resolutions placed before the company. So generally, they have only a right to vote on the resolution that affects the right of preference share, or it is for the winding up of the company or changing the composition of equity and preference share. But where the dividend has not been paid to the preference shareholder for a period of 2 years, they will have a right to vote on all the resolutions that are placed before the company. Is that clear? Guys, is that clear? When I'm asking about question and the concept, nobody is telling me is that clear. Everybody is focusing on where can we get these notes, where are the notes, what are the link. पढ़ने पे किसी का ध्यान नहीं है. Okay, now moving further to the Shaurya, how will be the resolution be passed? Resolution will be passed depending whether it has to be passed by simple majority or Special majority. If it was by simple majority, it will not be passed. If it is by special majority, it will be passed. So my idea on that question was not to determine whether the resolution will be passed or not. My idea in that question was to explain you the concept of proportion of voting rights. So I hope you have understood the concept of proportion of voting right. Guys, are we clear on the consequences when the dividends are not paid to preference share? Perfect. Now coming to the exemptions to the private company. So in the case of private company, they have a right to be governed by the MOA and the AOA. So for in section 47 is not applicable to a private company if memorandum or articles of association provide anything else. But to be able to claim exemption of 47, the private company should not have defaulted in filing of financial statements or annual return. So you can see that this private company, they can be more innovative in terms of voting right if it is permitted by their article. Yes, Janki, you are right. If the dividend is not paid for 2 years, they gain the advantage of voting right on every resolution. Yes, Vishwas, there is no restriction where it is said that you cannot hold both preference and equity shares. Yes, but when the entry is made in the register, separate details will be mentioned for preference shares and equity shares. Now, coming to the variation of shareholders' right. How can the rights of a shareholders be varied? So, so we know there are different classes of shares. So according to the different class of shares, the right that are attached to the shares of any class, they can be varied. But for that variation, there should be a power that has to be available in the memorandum or articles of the association of the company. So for this power, and plus such variation should not be prohibited by the terms of issue of such share and where no power is contained in the power memorandum or articles of the company. So coming to this section where we talk about right of shareholders, variation of the right of shareholder with content, it says, so section 48(1) says, where a share capital of the company is divided into different classes of the share, the rights attached to the share of any class may be varied with the consent in writing of the consent in writing of the holders of not less than 3/4 of the issued shares of that class. So preference shareholders are one class, equity shareholders are one class. So if you're trying to vary the right of a one class of shareholder, you will have to take the permission from not less than 3/4 of the issued shares of that class. So the holders who hold 3/4 of the shares of that class, they will have to approve that variation. How will be that approval be done? That approval, or so either they will give a consent in writing or by means of a special resolution passed at a separate meeting of the holders of the issued share of that class. So either they can give a consent in writing or a special resolution can be passed at a separate meeting of that class. Now, if provision with respect to such variation is contained in the memorandum or article, that means there has to be authorization that is available in the memorandum or article, or where there is no authorization in the memorandum or article, the variation should not be prohibited by the terms of issue of the share of that class. Ritik, is it a matter of concern that I don't give 5 minutes break at others faculty? Or I'm trying to utilize maximum time for teaching you guys? If you can't concentrate for 2.5 hours in a class, how would you prepare for such a humongous syllabus? So coming to the variation in right of shareholders. So 2 points we need to understand. How can the right of shareholders be varied? By receiving a consent in writing by 3/4 of the issued shares of that class, or by means of passing a special resolution at a separate meeting. But this can be done only when there is an authority. The authority either has to be available in the memorandum or AOA. Where the memorandum or the article is silent on the authority, the terms and conditions of the issue of shares should not prohibit in the variation in the right? Also, where the variation of rights of one class of shareholder affect the rights of another class of shareholder, the consent of the 3/4 of that other class will also have to be obtained to be able to apply that variation. So where variation in one class of shareholder affects the right of another class of shareholder, you would need the approval of that other class of shareholder as well. Now, when we are talking about consent, the consent has to be deliberately given, where an intimation is sent and when the shareholder does not reply to it, that does not mean a consent. That means that will not be treated as a consent given for variation. That means the consent has been denied. So generally, what will people do? Some will respond yes or no. Some will just sit silent. So silence is not treated as a consent here, right? So when you look at 48 clause 2, it says where the holders of not less than 10% of the issued shares of a class did not consent to such variation, they may apply to the tribunal to have the variation cancelled. So we are saying, so we are talking about that we need consent from 3/4 of the people, right? Let's say we got the consent from 3/4 of the people. Still, there are around 24% or 24.5% of the people who have not given that consent. So if the people who have not given the consent are at least 10% of the issued shares of a class, their composition is 10% of the issued shares of a class, then they can apply to the tribunal to have the variation cancelled. And where they apply to the tribunal in such a scenario, the variation will not have effect until and unless it is confirmed by the tribunal. Right? So, these people will have to make an application within 21 days after the date on which the consent was given or the resolution was passed. Right? So, when the application is made to the tribunal will investigate the matter and they passed a decision. And this decision is binding on all the shareholders. Now, this order that is given by the tribunal, this will have to be filed. A copy of this order is filed with the registrar. Now, what is the punishment if there is default in complying with the provisions of this section? In that case, the penalty for the company will be at least 25,000 rupees, but which may extend to 5 lakh rupees. And the officer in default will be punishable with imprisonment up to 6 months or with a fine which can extend up to 5 lakh rupees or with both. Class means equity share, preference share. These are different classes of shares, right? So when we talk about variation of shareholders, right, we are talking about equity share with DVR. So these are all different classes of shares. So Srishti is asking me, ma'am, if there are two types of preference shares, one with 8% dividend and another with 10% dividend, so they will be considered as different classes. They will not be treated as one class, okay? Yes, Varun, the decisions can very much be in favor of shareholder. Example of variation. So let's say a preference share was issued where
it came with a dividend at the rate of 10%, right? But somehow the company is not doing very well as of now, and it wants to reduce the dividend, the rate of dividend from 10% to 9%. So what's happening here? There is a variation in the shareholders' right, the right to dividend, right? So in this case, we will be needing the consent of 3/4 of the people holding that class of share. Is that clear, Janki? Okay. Now, coming to the next concept where we talk about the call on shares. What is this call on shares? So we know generally when an application for allotment of share is made, it is a certain amount that is paid, which is the application money, and only a small, let's say each share is worth rupees 10. The applicant might have paid only 5 rupees towards that share. So rupees 5 still remains balance. So the amount, the price of the shares that remains unpaid, it is called for by the company. So the company will issue a notice, they make a call for the payment on the balance amount. This is called the call on shares. So whenever the shares are partly paid, the company who has issued those shares, if they make a call to the shareholders to pay the balance amount in respect of such partly shares. Now, how these shares have to be made, that has been prescribed in section 49. So section 49 says these calls have to be uniformly made and there should be no differentiation for a given class of shareholder. So for one particular class, all the shareholders who are falling within the class, they will be called for making payment on the partly paid shares. So there could be cases that there are different amounts that have been paid on the same shares. So in that case, they will not fall in the same class. So let's say there are 10 shares issued for rupees 10 each. On 5 shares, the amount due is rupees 4. In remaining, the amount due is 6. So they will be considered at 2 different classes of share. So for one particular class of shares, the call have to be uniformly made. And when you look at explanation to section 49, it says shares of the same nominal value on which different amount have been paid up shall not be deemed to fall under the same class. So this provision will not be applicable where different amounts are paid on the same class of shares. Correct? Next section talks about the calls in advance and payment of dividend. What if somebody has in advance paid the money for the shares? That is, supposedly there are timelines. So when the company issues the prospectus, it tells you that how much amount has to be paid at the application, how much amount will be paid at the first call, what will be the amount for the second call. This is already defined. So where a person makes an advance payment on the call on shares, what will be the situation? That is provided in section 50 of the Act, right? So section 50 says a company may, if so authorized by its articles. So the requirement is there has to be an authorization in the articles, except from any member, the whole or a part of the amount remaining unpaid on any shares held by him, even if no part of that amount has been called up. So basically what's happening, the company, if it is authorized by its article, can accept advance subscription or advance amount on the calls. Okay? However, when a member of company limited by share shall have no voting right in respect of advance amount paid by him on the call till the amount is duly called up. So he will only have voting rights to the proportion of shares which are held by him in response to the calls that have been made. So let's say I hold shares worth rupees 100. I have paid rupees 90, but the company has made calls as of now only for rupees 40. So I will have voting rights only in proportion to the shares of worth rupees 40. For remaining 50 rupees, I will not have a right to vote. right? Now, section 51 talks about the payment of dividend in such a situation. So it says the company is permitted to pay dividends in proportion to the amount paid up on each share if so authorized. So basically this amount which is received in excess is rather considered as a deposit. So if you look at this example here, in a Moonstar Machineries Limited is authorized by its article to accept the whole or part of the remaining unpaid calls from any member, even if no part of that amount has been called up by it. Anand deposits the advance remaining amount due on his shares. So because it was authorized, the company is permitted to accept the advance amount, and this will be a valid transaction, right? But when we talk about the voting right will be only restricted to amount that has been paid for. Is that clear? So is the company liable to pay interest on the calls paid in advance? Yes, the company is liable to pay interest to the calls made in advance, but the interest is payable whether the company has profits or not. So you always need to understand interest is like a charge created on the company. So if the company has accepted calls in advance, the interest will be mandatory payable, and the rate at which the interest will be payable, that will be specified in the articles of the company. So if you look at regulation 18, it says that the interest cannot exceed 12% per annum. For the members who are paying advance call in advance, it says it cannot exceed 12% per annum, right? So is this clear regarding calls on advance? Yes, Jamil, you are right. For 2 years, the dividends should not have been paid consecutively for giving the right to resolution on every right to vote on every resolution. So consequently, for 2 years, the dividend should not have been paid to preference shareholder. Now, coming to the concept of issue of shares at premium. What is issue of shares at premium? So when the shares are sold at a price higher than their face value, it is called that the issued shares are issued at the premium. Now try and understand this from this point of view. So when we were kids, there used to be ice candies that used to come in a small packet like thing for ₹1 or 2. But if you try and buy ice lolly from Vadilal or maybe Quality Walls, they cost ₹20. Why do you pay this premium amount? You pay this premium amount for the quality, right? For the experience, for the safety. Similarly, if you go and eat momos at a fine dining restaurant, you might end up paying 500, 600 rupees for 6 pieces of momos. But if you have it on a kiosk, you might get it for 40 rupees. So what's being happening there? The goods are being offered at premium. Now, the companies which have an excellent financial record and have a great reputation in the market, they are able to offer shares at a premium, right? So here we are going to talk about such shares which are offered at a premium price. So if a share has a face value of ₹10, but it is issued at a price of ₹14, ₹4 is the premium. So this premium that is received by the company has to be deposited in a specific account, which is known as Securities Premium Account, right? It is mandatory that we have a dedicated account for the premium that are received on the shares, right? Similarly, the shares can be issued at a discount also. So discount is basically a loss to the company. We will talk about shares at discount also, but this is what is about issue of shares at premium. So let us go through section 52. Section 52 says where a company issues share at a premium, whether for cash or otherwise, a sum equal to the aggregate amount of the premium received on those shares. So let's say the company issued 10 shares at rupees 14. Their face value is rupees 10. It issued 10 shares at rupees 14. So what is the aggregate of premium received? 4 into 10, rupees 40. So this aggregate amount of premium that is received, it will be deposited to the securities premium account. And the provisions of this act relating to the reduction of share capital of a company shall, except as provided in this section, will apply as if the premium account were the paid up share capital of the company. So this amount that is credited to the premium account, it is accounted as the paid up share capital of the company. Now, the money that is deposited in the premium capital, in the securities premium account, they can be used only for certain purposes. What are that? They can be used towards the issue of unissued shares of the company to the members of as fully paid bonus shares, in writing of the preliminary expenses of the company, in writing of the expenses or the commission paid or discount allowed or any issued of shares of the company, in providing for the premium payable on the redemption of any redeemable shares, and for the purchase of its own shares or other securities under section 68. So for the buyback purposes, right? So these are the specified purposes for which this amount which is there in the securities premiums account can be issued. So it can be used for issuing fully paid bonus shares to the members, for writing of the preliminary expenses of the company, for writing of the expenses of or commission paid or discount allowed on issue of shares or debentures of the company, for providing for the premium payable on the redemption of a redeemable preference shares. So we spoke, then the preference shares are redeemed, they are allowed to be paid at a premium. So that premium amount that has to be paid there, the amount from the securities premium account can be utilized for that, or for the buyback of the shares under section 68. So these are the areas where the amount parked in the securities premium account can be utilized. Yes, Gitanjali, you are right that shares cannot be issued on discount, but we have the rights issue where the shares are offered to the existing shareholder at the discounted prices. One. So that is the rights issue that we are talking about. Why we cannot issue shares on discount? Because discounting of shares cannot be used as a tactics to attract people to invest money. So we have to safeguard our investors also so that they don't get cheated. As such, issue of shares on discount is not permitted. But yes, we will understand, we need to understand the meaning of shares on discount. So as of now, we were talking about the utilization of amount that is parked in the securities premium account. Other than that, in case of certain class of company as may be prescribed and whose financial statements comply with the accounting standards that are prescribed under section 133, they can use the securities premium amount for issuing fully paid up bonus shares to the members of company, for writing of the expenses, commission paid or discount allowed on issue of equity shares of the company, and for buyback of the shares. So these class of company that have been prescribed for, and if they comply with the accounting standards under 133, they can utilize the amount in the securities account, securities premium account, for these three purposes. Now, what are these prescribed company? That we will have to see the rule for that purpose, right? Is that clear? Are we good till here? Guys, is this fine till here? Okay, some students want me to receive repeat calls in advance. So what I was saying, so generally the payment on the shares can often be made in installments, right? So if the amount, there is a part of the amount that is remained unpaid on the shares, the company can make a call for it. Please make the payment. I'm calling you to make the payment. It sends a notice for that purpose. But there are certain people who make the payment on the shares in advance. So you have not received the call from the company, you have not received the intimation from the company for the payment of the unpaid amount, but you have already paid that amount. In that case, where the calls are paid in advance, where the amount unpaid on the shares are paid in advance, in that case, the person have a right to receive interest on the amount paid in advance, but he will not have a voting right on the amount paid in advance. His voting right will only be proportional to the amount paid as per the calls. So let's say a share was worth rupees 10, rupees 3 was to be paid at the time of application, rupees 4 was to be paid at the time of first call, and rupees 3 was to be paid at the time of second call. So Mr. A, when he was purchasing shares, he paid rupees 9 at the time of allotment only, right? So what has happened here? He has paid the amount in advance. So as of now, the first call and the second call has not gone. So at the time of application, he was supposed to pay only rupees 3. So his voting rights will be only in proportion to the shares held worth rupees 3. But he will have a right to receive interest on the extra rupees 6 that he has paid. Is that clear? Is that clear? Calls in advance, is this clear? Who had asked me about repeating calls in advance? Who did? Okay, whosoever had asked for it. So this was about issue of shares on premium. Now, section 53 says that it is prohibited to issue shares at a discount. And any shares which are issued by a company at a discounted price is void, and the company who contravenes this provision, the company will be punishable with fine, which will not be less than 1 lakh rupees but can extend up to 5 lakh rupees. And the officer who is in default, he is liable to imprisonment up to 6 months, or with fine, which may extend to 5 lakh rupees, or both. So minimum fine is 1 lakh to 5 lakh, or with imprisonment and fine, both. But there is an exception. A company may issue shares at a discount to its creditor when its debt is converted into share at the time of resolution or debt restructuring. So what happens? Sometimes the companies of the debt of a company goes to such a level that it becomes difficult to incorporate the company, and company goes into insolvency. So in that case, the insolvency professional who comes in, he restructures the debt or proposes a resolution plan, the plan to resolve the debt problem of the company. In that case, the shares can be issued at a discount to its creditor. So what happens? The creditors, let's say the creditor is supposed to receive rupees 10. So here, because the company does not has rupees 10 to return to the creditor, he will the company in the debt restructuring plan issue shares to the creditor at a discounted price. So let's say if the face value of one share is rupees 10, instead of one share, 2 shares will be given to that creditor. So creditor will become happy, okay, fine, I have got 2 shares. Let the company start working and there is restructuring happen. When the company will make profit, I'll get more money out of it. Right. So under such situation, discounting, issuing shares at a discount is permitted. Right. And this restriction that we are talking about, it only is applicable in the case of issue of equity or preference share, not for debt related products. So for issue of bonds or debentures, this restriction of discounting is not applicable. Right. Next thing that we talk about is sweat equity shares. Now, what are sweat equity shares? So here there are 2 terms which students often use interchangeably ESOP and sweat equity. ESOP stands for employee stock option. ESOP means the employee has been given an option to purchase the shares of a company at a particular price, which will be very attractive. And sweat equity shares are the equity shares which are issued to the directors or employees of a company for the effort or the value they bring to the company. So let's look at the definition of the sweat equity shares that have been given. So this term sweat equity shares is defined under section 2 clause 88 of the Companies Act. And sweat equity shares are such equity shares as are issued by a company to its directors or employees at a discount or for consideration other than cash for providing their know-how or making available rights in the nature of intellectual property rights or value additions by whatever name called. So let's say I'm a person, I'm an inventor, right? I'm an employee of TCS, but I have invented a process through which the software of the TCS will increase its speed by 10 times. So I have developed that IP while being employee of the company. So the companies, in order to retain such valuable employees or such people who contribute to the growth of company, it offers them a equity shares. So equity shares could be offered in return of IP rights, or it can be offered at a discounted price for a consideration other than cash also. So this is the concept of equity shares, sweat equity shares. So here what's happening, instead of remunerating or appreciating employee in terms of money, it is appreciated by issuing him sweat equity shares. So at a lower level, you will see the employees who perform well or the performer of the month are given some coupons, shopping coupons from Shopper Stop, M&S, or they are sent at holidays. At senior levels, you will see that such employees are offered sweat equity shares. So they get a right or the equity in the company. Yes, Shruti, you're right. So now the question arises, are the sweat equity shares same as stock options? No. In the case of stock options, in case of sweat equity shares, it is like a non-cash incentive or a compensation to the individual. In this case, real shares are allotted to the employee upfront. Whereas in stock option, there is a right to an employee to purchase the share of a company in future at a pre-agreed price. So ESOPs, in case of implied stock options, shares are not immediately allotted. In case of sweat equity shares, the shares are immediately allotted to that employee. So there are separate guidelines for sweat equity shares and ESOPs that are issued by the SEBI. Now, what are the conditions for the issue of sweat equity shares? So section 54 says that a company may issue a sweat equity share of a class of shares if the following conditions are fulfilled. Firstly, it is authorized in the special resolution passed by the company. Technical know-how means, let's say ABC company knows how to manufacture a device that can reduce the electricity composition. So it has a patent. So that company is based in US, and this company also wants to expand in India. So when it imports that device from US to India, there are a lot of duties, and because of which its sales are low. So what will company do? That company will try and collaborate with the Indian company, and they will say that I will teach you how to manufacture this device, but in return, I want the equity in the company. So this is what is know-how. So it could be technical know-how, a process know-how, a management know-how. It can be anything. Know-how means how to do, knowledge of knowing something to do. Okay. So coming back to section 54, which talks about sweat equity shares. So the sweat equity shares can be allotted where it is authorized by a special resolution passed by the company. And the special resolution should specify the number of shares, the current market price, the consideration, if any, and the class or class of directors or employees to whom such equity shares are to be issued. Now, where the equity of the company are listed on a recognized stock exchange, then they have to be, the sweat equity shares has to be issued as per the regulations that are made by the SEBI. And if they are not listed, the sweat equity will be issued according to the Rule 8 of Share and Debenture Rules 2014. Now, what are the category of employees to which sweat equity can be issued? It includes permanent employees of the company, whether they are working in India or outside India, directors of the company, whether a whole-time director or not, and thirdly, employee or director as mentioned above of a subsidiary in India or outside India or of a holding of the company. So all these category of people, sweat equity can be allotted. Now, what is the meaning of value addition? So we have seen that sweat equity shares are allotted for value addition. So value addition means a contribution to the company which has anticipated economic benefits. See, if the company will get a benefit of 100 CR, it will share maybe 10 lakh to its employees or 20 lakh with its employee. So value addition means actual or anticipated economic benefits derived or to be derived by the company from an expert or a professional for providing know-how or making rights available in the nature of intellectual property by such person. So along with the remuneration that is payable under the contract of employment, he is also issued the sweat equity shares. Now, what are the timeline for allotment of sweat equity shares? So the allotment of the sweat equity shares has to be made within 12 months from the date of passing of resolution. So the special resolution under which it is authorized to issue the sweat equity shares, 12 months from that date, the sweat equity shares have to be allotted to the employee. Now, there is a restriction on quantum of issue of sweat equity shares. What is the quantity of sweat equity shares that can be issued? So, for one time, the company can issue sweat equity shares of up to 15% of existing paid capital or value of up to 5 CR, whichever is higher. So at a particular time, in one go, the maximum percentage of sweat equity could be 15% of the paid up share capital, or the value of the sweat equity share can be a maximum of 5 crore rupees, whichever is higher. During the lifetime of a company, the company can issue sweat equity of not more than 25% of the paid up equity. So if paid up equity is 100 CR, sweat equity of up to 25 CR can be issued at any point of time in the entire life. However, where the company is a startup company, it can issue sweat equity up to 50%. So sweat equity should not exceed 50%. It should be less than 50%, like 49.9% of its paid up capital up to 5 years from the date of its incorporation and registration. Right? Now, whenever the sweat equity shares are issued, they come with a lock-in period. Lock-in period is the period during which the shares stand non-transferable. So the lock-in period for a sweat equity shares is 3 years. Now, when the sweat equity shares are allotted, there is a value allotted to them. So how will you determine the price? So that price of the share is determined by a registered valuer who provides the justification for such valuation. Now, this sweat equity share is allotted in return of IP or in return of the contribution that you have made or value addition. So the value addition, the value of that value addition has also to be determined. So that value is also determined by the registered valuer. So let's say as per registered valuer, my contribution or value addition is worth rupees 10 lakh rupees. So accordingly, I'll be issued sweat equity shares. So what if the sweat equity shares are allotted in return of non-cash consideration. So in return of IPR, I am allotted sweat equity. So how this amount is treated in the book of account of company, that is provided in rule 8 of 8(9). So this you will understand when you will be studying accounting of non-cash consideration. So where the non-cash consideration are such that they are depreciable, they will be carried into the balance sheet of the company in accordance with the accounting standard. But where it is not depreciable or it cannot take the form of amortizable asset, it will be treated as expenses as provided in accounting standard. So this is the treatment of expense that is incurred by the company for sweat equity shares. What will be the treatment in account book that has been provided here? So whenever the companies issues the sweat equity share, there has to be disclosure in the director report. A register of the sweat equity shares has to be maintained in form SH3 and kept in the registered office of the company. And the sweat equity shares are ranked pari passu with the in balance or in equity or at par with the equity shareholder. So they have the same rights as available to the equity shareholders, right? So this was all about the equity shares. So with this, we have completed equity shares. However, I wanted to do the types of preference shares, its redemption also, but it's already 9:45 and I would not be able to stretch the class further. So we will stop our class for today here, and whatever the remaining is left, we will take in the next class. Okay. So all of you are requested to revise what we have gone through, and if there are any queries, we will take up in the next class. Thank you very, very much. All of you have a good day. Take care, study hard, and stay safe.